But yeah, so thanks for doing this, man. How many years since inception?
3 years plus. Yeah.
3 years, but we met 2019,
We
right?
met 6 years ago,
Yeah.
6+ years ago.
Yeah.
That time I was still working for Country Garden. Yeah, Country Garden Malaysia.
Oh my God,
Forest
you work for
City.
Country Garden.
Yeah.
Holy shit, bro. Where are they now? Well, it doesn't matter, right?
Difficult situation for them in China. As you know, the China economy, driven by real estate frenzy over the years.
Yeah.
So being the poster child, badly hit. But in terms of their other businesses, some of them are still surviving, still listed. But unlike Evergrande, they haven't crashed. So they're still around.
Yeah. So basically, fund manager for the last 3.5 years.
3+ years, yeah.
Assets under management gone from 0 to about 125 now.
Correct.
You've made it out of the woods, right? Essentially, right?
Essentially, yeah.
Yeah. So how did you start? Why did you start in fund management? Because it's very crowded, right?
Yeah. Very good question. Chong, actually, when I met you, I think we had a slight conversation, you may not remember, but I told you that eventually I'm going to strike out at a point in time, even though I was working.
I remember, now I remember.
But the question was, I didn't have enough network, I don't have the background, I don't have the influence. So very, very safe career path, build it up to a point where I felt that I had enough network or connection out there, and also the recognition at least. Then at the 10th year, I said that, 10.5 actually, I said enough. I have to come out to strike out. If I don't, I wouldn't dare.
Did you always know that you're going to be an entrepreneur?
Yeah, definitely. It was just a matter of time, but I had to build up the necessary experience. I think the biggest difference between me and the new entrepreneurs today is some of them just come out right out of college, or may not even go to college, and they start their business. For me, it was very different. It was a very well-planned, thought-out strategy. In fact, what really got me planned out for this journey was when Securities Commission actually introduced the boutique fund management framework back in 2015. That was the one that really set my goals at that point in time, because they lowered some of the requirements compared to traditional full-fledged requirements to set up a fund. And that shows that the Securities Commission was trying to make our capital markets more friendly, and there was an opportunity there. But unfortunately, I don't have the capital, I don't have the network, so you have to build it. And I had a few good friends who were in the industry, but they haven't met the minimum threshold of experience. So that was when I decided to strike out, and I told them that it's time, let's do it. But they thought I was joking, at the point in time. Yeah, because who would give up a high-paying job to come out? And interestingly, after I came out, 6 months later was COVID. But the application process for my license took almost 2 years plus.
Yeah.
So that's why we only started in 2022 April.
So did you always study, did you study fund management, financial management?
I was a graduate of London School of Economics.
Yeah.
I have an external module in economics. Yeah. My fundamental is like you, I think, law.
Yeah.
Law degree was my base. But I've always been interested in the capital markets industry. Even as a lawyer, I was doing a lot of corporate M&A IPOs. But that's the back end of the work, right?
Yeah, a lot of CIOs now who actually have a legal background. Too many of them actually.
So that helps in terms of my application, my structuring and all. But in terms of business, for me it was very simple. I like businesses, but which business actually gives you the wide exposure to an array instead of just a single one? Fund management gives you the full exposure. Yeah.
So a lot of people who look at the capital markets and they talk about investing, I think they don't realize that a huge part of the job is actually fundraising, because without funds to manage, there is no business, right?
Correct.
And it doesn't matter what your view of the market is. And generally speaking, the more money you have to manage,
the harder.
The better. Well, yeah, of course. Well, then the more you can put your principles, your investing principles to use. So those early years are quite hard, right?
Very hard.
Going from 0 to 125. What was the pitch to them? What was the pitch to investors?
It was very simple, because Malaysia capital markets over the years has been quite stagnant, with specific modules dominated by some of the big boys, right? So they do a certain way. They use the relationship, sales force, agents to market their funds, keep launching new products. And over the years, we realized that there is a demand for a growing personal touch, and people who are managing the money, they want to know who is the person, who is the fund manager, what are your thoughts? So that niche personal service usually is missing from big boys in town. So there is a crowd that requires a lot of attention in this particular manner on how you allocate the money. So that's one angle we saw. But I've always felt that Malaysia is going through, similar to a lot of countries in this region, a wealth transfer in the next 20 to 30 years. So there's a big boom and tailwind that can carry in the coming years. So while it's true that you said that it's very competitive, but actually, Chong, there is a tailwind that will carry. Because unlike US, Europe, Japan, wealth transfer has been around for many years for them, decades in fact. But for Malaysia, the baby boomers to the next generation is the first. So this next 20 years, there is a market opportunity for Malaysia.
So you're talking about the wealth transfer not between asset classes, but between generations.
Correct.
Parents to children.
Correct.
Yeah.
So that helps, you see. And if you look at our capital market structure today, the big boys or the veterans of the industry, they are all between 50 to 70 years old. They are together with the baby boomers generation.
Yeah.
If you talk about the new generation of fund managers, there's still a void or gap. So I felt that at that point in time, there is an opportunity in the market, plus it's aligned with my interests. So why not give it a try? Yeah.
So when you go out and raise funds, right? What's the pitch? I mean, obviously beyond the human touch, right?
Yeah.
And the fees and all that. It's really the returns on capital, right?
Definitely. Okay, just to share a little bit, not to promote or anything, but we specialize in small mid-cap investments.
And are you only in Malaysia?
We were only in Malaysia, but today we got about 25% in regional. So your Southeast Asia, including Hong Kong, China, but not US and Europe. So, and ex-Japan. So the pitch was very simple. We said if you just go with KLCI index blue chip, you go with, and if you compare to SP 500 or anything, you will see the returns over the years has been quite not that good, right? But if you look at small mid cap, there are actually a lot of alphas. And a lot of small mid cap over time, if you find the good ones, they become 10 baggers. And we have seen it in many, many examples. Let's just say Vitrox, Ugitech, or whoever, those names that are around. So the question is finding these kind of names in the market. But the big boys generally don't touch them. Why? Because their fund size is so big. When they go into small mid cap, they can't exit. So for us, we can, because we are starting from small. So that gives us the alpha and consistent return that we've delivered. So that was my initial pitch. But also, I think a lot of the high net worth clients, they have grown frustrated with the unit trust model over the years, and the high upfront fees, and also the inability to discuss their portfolio with the fund manager who is managing. Because the thing about a fund that performs usually is reliant on the talent, and a lot of them change jobs, then suddenly the fund underperforms. So we see this kind of problem with the big boys. That's why there is an opportunity or gap in the market. And that's how we usually pitch.
Okay, so I mean, so many things to discuss here, but essentially, when you talk about wealth transfer to the younger generation, right, these are usually people, I mean, the older ones may be in their 30s by now, but a lot of them are younger, right? Are they looking at equities like maybe their parents did, or are they looking at other asset classes as well?
Okay, let's talk about the older generation baby boomers. When you think about how they allocate their assets, usually I would say majority is in one asset class, real estate, right? Properties, lands, plantation.
Even then, don't they look at stocks, no?
Rarely, because they have been through 1997 Asian financial crisis. So a lot of them don't believe in the stock market, or even if they do, it won't be a local stock market, right? And when it's not local stock market, they're reliant on foreign experts. And if the foreign experts goes through the private banking distribution channel, they realize that a lot of profits are eaten up by the fees. So this is essentially the idea where we know that it's not broken, but rather the model has been very entrenched. So there's a flavor where they want to change, including managing on their own, like family offices, private vehicles. But as a business entrepreneur that probably runs a manufacturing industry, you may be very good in your business, but you may not be very well versed in the capital markets. So people like us, professionally trained over a number of years, our team has gone through the run of the mill. We can actually deliver the kind of lacking of experience or know-how that they want. The only thing is that where's our value add? So another pitch is that I said the one that managing or many are the veterans in the industry, right? They're good, but will they still be around 20, 30 years? We're the next generation, right? So you want a fund manager with a long runway,
energy,
right? So that was how we also pitched them. And then you also want one who will go along the journey with your children, right? So that's where our pitch come along. Of course, trust need to be built. In the start, they just give you a small amount, but as your performance grow, and more importantly, they see how you run things in a very professional, and because I'm a lawyer by training, so they know that fiduciary duty is something I actually uphold dearly. So those kind of things help us open the door subsequently. And till today, Chang, to be very frank with you, we have no sales force. It's all word of mouth, referral. And of course, the media really helps.
So I think for me, what is really important is how you look at the markets and how you combine the names, right? Because that is really the secret sauce, right? It's the selection process.
Correct.
And we know that, I mean, empirically speaking, when you look at fund management generally, I think 75% of fund managers, they don't beat the index. I think generally speaking, the S&P returns 10 and 15% a year. The KLCI somewhere around 8 to 10%, right?
Much lower.
Yeah.
Yeah.
Okay, so
KLCI is much lower.
yeah, so I'm trying to be generous here. Okay? Let's just say 5 to 10%, okay?
Yeah.
So that's your hurdle. And of course, FD at 3%, I mean, that's the kind of like, right? People say, oh, EPF gets you 6%. Wow, amazing, right?
Yes, correct.
But I think the real hurdle is maybe 15 to 20% because when you factor in inflation
Correct.
and currency devaluation,
That's right.
all right, and then your hurdle rate on index funds. So when you look at I mean, the markets have been really turbulent the last 5 or 6 years, right? This exogenous events, and COVID, and this whole disruption thing, tariff wars and geopolitics and all that, right? What's the methodology for you guys?
I think, Chong, you've covered the sector for a long time. You're very well versed with the problems and all. So if you are only in one asset class, you're only in public markets, then you're subjected to this up and down. And if you consistently want to beat the public markets, it's a tall order unless you have really a amazing proprietary model that can outbid. The only one that I think that has that kind of proprietary model solely focused on public markets that did very well over the years is Renaissance, the fund, quant fund in US. But apart from that, there's always a mixture of asset class that help you to blend it out. So that's where we are growing. So Tradeview Capital essentially is not only a public markets fund, right? We have a private, we are expanding into the private markets function. So including in some of our allocations in our past few years, we also allocate maybe 20% to private markets before they go for IPO. So that gives you that
private
alpha.
equity lah.
Yeah, not really private equity. Private equity is that you probably have to hold them for 5-10 years and grow them. Not necessarily. It may be opportunistic just before they go for IPO or at the point where they feel that they are ready. And their size in Malaysia is not like your big ticket like US. Private equities put in 50 million, 100 million US. No. Malaysia, because of the listing rule requirement, profit test, and ACE market not requiring that, actually a 5 to 6 million PAT with our huge pool of SMEs in Malaysia, there's a lot of private markets opportunity. So that's where we are going to do. By having a private markets and public markets portion, we will blend out the market cycles, all the issues that you're mentioning today. So when good times, of course, you run with the public markets, right? When bad times, your private markets will then come in to support you in terms of your fluctuations. So that's how we blend out. And that's our strategy moving forward. And we will continue to build into a multi-asset, multi-strategy fund. That's our idea.
Okay, but you need to be invited, right, or to have access to these companies, right? So how do you look at that? How does that happen?
Very thankfully, over the years, we have built a very good reputation in the market. And because our ticket size is not huge, and we don't need a substantial amount of control, or like some of these PE funds, I go in, I need to take control of the company. We don't. We can take a significant minority. But more importantly is that Malaysia has one thing that every single country in Southeast Asia envy, which is our SME pool. You can say how great Singapore are, because how great Singapore is because they can attract all the monies and everything. But they always envy us because we got very good SME pool. And a lot of SME pool, coupled with the first tailwind I mentioned, is going through wealth transfer. So there are extremely huge amount of companies out there either looking capital to help them grow further, or looking for capital to help them facilitate or professionalize or institutionalize the transfer. So we have all these opportunities in Malaysia, and believe it or not only we reach out, a lot of them reach out to us voluntarily, and we sit down and have a chat. The question is whether are they viable.
But when you talk about pre-IPO, so just before IPO, this is before they filed, is it?
Before they file.
Okay, before they file. Okay, so your network is among the SME owners.
Yes, correct.
So then it's just taking a position just before they file.
Yeah, just before they file, or maybe they tell I want to file in 2 years, and I look at numbers. Let's just say their PAT is 1 to 2 million. Then if they want to file, they probably need 5 to 6. So you just need a little bit of growth capital. So traditionally, what do? In the baby boomers generation? Bank. They go to the bank, I take loan. But you and I both know loan probably 8 to 9%, right? Profit margin 20%. Erode 11%. With that 11% net profit, you need extra maybe 10 years to grow to a size before you can even list. By the time you can list, what happens? I'm too tired, I pay off my debt already. I don't want all this nonsense, I don't need any. We're happy, let's just stay with this. So this is where we come in and inject to help them to get to the next level. And it complements our public market strategy, right?
Yeah.
Because when you get to that, my public fund essentially will be able to absorb or take them as a block. So we are all the way at the point. So PE is a bit different. PE's problem is that they go in, they value add or enhance, which includes potentially cost cutting, firing, or stripping for parts. We don't necessarily have to do this. At some point in time, some of these companies, They just need growth capital, but the capital has to come from equity rather than credit. Malaysia's biggest problem, I feel, over the years is they rely on the traditional model, collateral-based financing, credit-based financing, and that impacts growth. US is very different. If you talk about credit financing versus equity, 9 out of 10, I would say they grow their capital via equity financing. So it's very, very different. So if Malaysia SME will get to the next level, we need more of this kind of fundings. And the market is big enough. It doesn't have to be only me. Yeah.
So it seems to me that you're kind of like in kind of like honeymoon era now, because you've made it through the survival stage.
Correct.
But you're small enough to still do these small deals and get the real alpha 5, 10x, right?
Correct.
Problem is when you get bigger, then it becomes a bit more difficult, right?
That's
like
right.
what EPF is going through now, right?
Yes.
You're 1 trillion AUM. How the hell are you going to move the needle?
Very difficult. Right? I think, Chong, you correctly point out. So at least you can see the trajectory, right? So it's a very good sweet spot for us all the way, at least another decade. But if we really get to a size that's that big, that's a good problem to have, not a bad problem.
Yeah, of course.
Yeah.
Of course.
So then,
you
see, so then at that point in time, you really have to be very innovative in terms of how we do it. So of course, there are a lot of people talking about alternative investments, private credit. There are a lot of things that we can really do. The question in the size of EPF itself, they have to go global because of their size, right? So the allocation, if I'm not mistaken, is 60-40. But I heard they're going to reduce.
Local foreign, is it?
Local foreign. Local is 60-40. Originally, I heard now it's 65-35. Basically to support more our capital markets in Malaysia. So you can see Temasek GIC is the same thing. They go global. You don't have a choice because of their size. But that being said, global also have its own set of problems, especially now, right? Yeah. So it's a headache that once your fund get to a certain size, so the only way that maybe EPF can consider is to diversify the asset classes more instead of just the traditional fixed income, public equities, and small amount of private. So they probably have to diversify a little bit more.
So you talk about the challenges of unit trust, right? And I know, unit trust, don't even get me started. Okay? But the cost structure is something which is not sustainable. Okay. To me, the direction is always downwards because you got no choice. It's a cost factor, right? Where do you think it's optimal for investors? Because as an individual investor, right, you're always thinking about opportunity cost and capital allocation. You want to find the best return for the lowest possible cost, right?
That's right.
Where's an optimal level for costs, for fees to pay as an investor?
I think maybe I just explain a little bit because I know a lot of people may not have the background or context of the fees, right? So when they say upfront charges, what your upfront, basically your sales charge. That one is where they pay the commission for the agents or sales force to bring in the AUM. Then there's the management fee, which is earned by the fund management company, and then the performance fee portion, if there is. Some unit trusts don't have performance fees. Mostly wholesale fund will have. So these are the three cost elements when you put money. So unit trust model, a lot of people are complaining or unhappy is because of the upfront sales charge. Some can charge as high as 5.5.
You're starting underwater,
precisely.
Right?
So you put 100, you actually basically down
investing 95.
95, precisely. So a lot of people are not happy with the unit trust model because of that. But I believe that due to competition and competitive landscape, over time this will come down. And I've seen some sales charge now from the heydays of 5% is now about 2.5. This is more of the norm now, right? Management fee, 2%. That is the usual in the past.
Too high.
So now a lot of them coming down to 1.8, 1.5, right? If you talk about Singapore, it's 0.65. But that's a problem. A lot of people are facing steep competition in Singapore. But why Singapore they have to do that? There's also another reason. It's because there's 600 over fund management companies all vying for the international pool of money, family offices. Now, if you go for performance fee, then it's your usual 20% above the hurdle rate.
Your watermark.
Your watermark. So Malaysia, traditionally, if you look at the structure in this manner, people are just used to 5.5, 2%, and no performance fee for the unit trust model. But I'm seeing the landscape change. Like even boutique funds like us, we have our structure that totally don't adopt the unit trust. And that is another reason why it makes it very attractive to potential clients, right? So they won't feel upfront, I'm being ripped off. One of the most common questions I get is, okay, I give you this money, sure, I agree to pay you this management fee and everything. But what if you lose money, do you pay me back?
No, of course not.
So that's the question I always get asked the most.
So I think the unit trust industry is something like, I think it's 700 billion or so. How much is
Malaysia, it's almost $1 trillion.
Yeah, it's huge. It's massive, right? And then what really, really gets me is those advertisements that they put out. Invest with us in your retirement. Then they show one old couple on the beach holding hands and the sun is going down. And then I'm thinking, That's not the investor. That's your sales agent. That's the unit trust agents on the beach. That's not me and you, because me and you was like, boleh ya. So the thing is, so the regulators have allowed that to happen because they want to build the industry. I get it.
Yeah.
But things have to change. You know, things really have to change. You cannot keep on charging people at the front. Come on, right? Pay them in the back. Yes, if you make money, sure. Then you align interests.
Correct.
But there's no alignment right now. So
Because
that's a big
don't have
problem.
performance fee. You see, like us, very different. We are small, right? My fund manager's bonus pool or profit sharing comes from their performance fee. It don't come from their management fee. So which means the interests are aligned. If you perform, you get it. If you don't perform, before year end, you already know how much you're drawing. So that is an important element that really should incentivize fund managers. Of course, the banks have their own considerations, right? Because we got this cost, we got that cost. We can only give you the upfront fee. That's your fee, and that's it. You know. So, but that is how they have worked and built to that size over the years. But you're right, regulators know that. So that's why effective.
It's not new. It's been around for how many years? People have been complaining for so long.
Yeah, I think effective next year, SC is going to increase the fees for some of the unit trusts and funds. So that means those has a lot of unit trusts or a lot of funds, even if dormant or zombie or not. As long as you have that, you have to pay a fee. So then that incentivizes the industry to basically close down non-performing funds, consolidate performing funds, or whatever.
That's a roundabout way, right? They should just mandate a lower sales fund, right, to a maximum, right? I mean, they can do it for stockbroking commissions, right? It's not down to what 0. whatever %, right?
I think
per trade. They should do that.
Actually, that one is not regulated per se by the regulator, meaning they don't impose on that. They let the market forces dictate. The reason why stockbroking dropped so much is because of the rise of digital brokerage, technology, and all the less manpower or back-end OPEX. But for fund management, because the model of the industry is still reliant on sales force. When you don't incentivize your sales force enough, they won't be able to bring the money in. Right?
Yeah.
So that is the challenge of the industry. Then not forgetting scams. Today there are so many people who are proliferating scams, agents for scams, which they may or may not know. So then the industry itself, regulated versus unregulated, that's another pool of a class of people who are putting money. So they have a lot of challenge, and it's very difficult for them to say that, hey, lower your fee. You know, that's very difficult for them to do so. But the industry will consolidate over time.
Yeah, so the digital side, right, on the fund management, you got Robo-Advisories, right? So you just cut out the whole middleman thing, then you can just automate the whole process. I see the model. It's hard, but I see the model, right? And then you just go and buy an ETF somewhere. You can have ETFs on anything under the sun, right? And then you're paying essentially between 0.01% to 0.3%. And you just follow the index. I mean, no-brainer, but some indexes are giving you 10-15%.
That would be your SP lah.
Correct, SPY and all these things.
Correct.
What's wrong with 10-15%? You can double your money in 7 years.
No, that's very good.
Right.
You know, but there's only a limited amount of ETF that can give you this kind of return, and some of the ETFs are very cyclical. Sometimes they do very well, but when you're talking about SP 500, it's different because it's the whole basket of global big names.
So you can do a little bit in QQQ, you can do a little bit in SPY, you can do a little bit in whatever, right?
But this is the problem. Some people do not know how to do the allocation, so then they rely on robo-advisors or digital advisors. The problem with the robo-advisors in Malaysia specifically, if you talk about ETF, I can buy myself, I can allocate myself. If you go through them, if their algorithm or proprietary model doesn't work well in a down market, for example, and then they get someone to manually come in to adopt, which happened in 3 years ago, then it's worse than a fund manager, because the fund manager's expertise
for that 1 year,
for that 1 year, and that impacts that particular confidence. But coming back to it from the business model perspective, while the idea makes sense, right? If you look at a lot of robo-advisors in town and abroad, majority of them, even backed by big names, are bleeding through their nose because fee structure is too low. Everything is given towards it's
a long game, right? Yes. At the end of the day.
So someone has to continue pumping the money. From the business perspective, it cannot sustain. So that is the difficult part. You can keep raising funds, but whoever that you're paying or whatever that your cost to operate, that particular cost will eat into your sustainability or viability. So that's why from the start, even though I had the option of applying for a digital fund management license at that point in time, I told them that the model is not matured enough and you need to have a certain scale. The few players in town, at the end of the day, their biggest problem is achieving profitability. If you have the capital that continues to inject, then fine. But if you don't have risk of closing down, it's very real. So I have to, from the business perspective, this is from business. Yeah.
So moving on to public markets, right?
Yeah.
And I'm not sure whether you are the ones making the decision yourself, but I'm sure you're involved on a daily basis, right?
Yes.
So how are you looking at the markets the last essentially the last 4 or 5 years since COVID, right?
Yeah.
Things have changed a lot.
I think if you talk from a Malaysia context, the biggest problem for us for 4 or 5 years was the political change. That was the number one issue. Fundamentally, nothing wrong with the country. It's the governing or administration, lack of confidence by investors, that actually affected the performance of our market. But then, when you had a new government that with more clearer policy, you attracted more fund flows. And last year was a great year for Malaysia equities. So we're top performer and second best performer in ASEAN, third best performer in Asia. And because we were riding on a very good team, which is your AI, data, infrastructure, rollout and all. So Malaysia has all these kind of.
Yeah, but the problem with that is on a CAGR basis over the last 5 years, you've got to divide that nice number last year from over 5 years, right? Then you're like, every year, I must well just put money into EPF.
Yeah,
because last year the Malaysian stock market did what? How many percent return?
Last year did about, if you talk about the index, it's close to 12%. 11%. Yeah.
Correct. So 12% over 5 years is?
It's not that good.
But lower than FD, right?
Correct, definitely. So, but we also don't forget, we also had the glove run. That if you manage to
get out.
Yes, correct.
I know some people still stuck inside there. Okay.
So it really depends on which, and then there was the tech run. So there are market cycles. That the problem is Malaysia's stock market. We always need to assess from 3 angles. Number 1 is your foreign fund. Number 2 is your local fund. The third is your retail investors. Foreign fund comes in when policy certainty is there. They see a tailwind in this market, then they will come in. Retail investor comes in only when the market is hot, and local funds essentially just prop the market. So that's what's traditionally been happening. But if you compare us to Singapore, except for last year, Singapore is in a more difficult, dire situation. Why I don't compare to other countries? I just compare within the region first, because the IPO market is not good. Our IPO and ACE market has been very vibrant.
Okay, wait, stop. I just want to chop you there. So last year I think we did 30. How many IPOs?
We did 55.
55, sorry. And they're aiming for 60 this year.
Yeah, which is hard this year. Yeah.
Okay, hard. But 55, how many are above water?
Last year, 80 plus. 85% of them were above water. Last year.
Okay. At the end of the year lah.
At the end of the year.
But how much more?
How much more has been now?
No. So they listed, right?
Yeah.
Then by the end of the year, 8 out of 10 were still up on the IPO price. Okay.
Average about 10 to 15%. Average about there.
Okay.
Yeah. So they did very well.
So now?
This year is a lot of them dropped.
Have come off, right?
Have come off. This year has been a very tough year. And this contributes to two angles. Number 1, of course, foreign fund has been exiting our market.
Yes.
Second is our retail investors.
Yes.
So too short term. So when you're short term, what happens? Basically, you make money on first day or second day of IPO.
And then you chow. To me, the other thing is also the pricing of the asset.
Yeah.
Price too high.
Okay. So
greedy.
Valuation wise, this one I totally agree, because there are some industries they just go for the top range.
Maximum.
Right? But there's also the underprice. So it really depends. That's why I always say, people say if I buy IPO, especially last year, I should make money. But that was during a market that was not that rational. If you really pick, there are some names that still do very well.
Yeah.
But if you everything also you buy, then of course, so that's the problem with retail investors. When the hype is there, you just go in. But then when it's not, then you just throw everything. That's very difficult to have a sustained growth. You look at US retail investors' participation is close to 50%, 50 to 60 if I'm not mistaken, plus minus. 50 to 60% of their personal asset allocation is to equities for retail investors in that country. Us, we are still real estate heavy, or FD maybe EPF some.
Yeah.
But the problem is that when the equity portion not sophisticated enough to understand certain companies that does well. And I agree with you, Chuang, but if you look at our history, Malaysia's history of companies that are $1 billion and above, many of them were small cap companies.
I agree. I totally agree. Vitrox and all these guys. EQUITIES, I don't understand.
But have to be selective. Have to be very careful. Instead of hot tips, syndicated pump and dump stocks, you have to avoid all this. And then if this guy, for example, tells you, this is my core business, but suddenly you see he venture into a few others, and everything also he says he want to do, which is the flavor of the day. These are companies you should avoid.
Big problem.
Because how many Robert Koch are there? And even Robert Koch put it over how many years? 50, 60 years before he can one industry to another industry. These people within 3 years, they can change 6, 7 industries. So that's something that our retail investors really have to be very careful.
So you talk about the US experience, right? And you talk about how a large portion of the population are into equities.
Equities.
I think there's at least 2 reasons for that. The first of all is the fact that their media machinery is amazing, right? The corporate CEOs are so willing to go out and talk.
Yes.
They go on the podcast, they go on to the Tonight Show,
Yeah.
you know, they go on CNBC all the time. I mean, they are culturally aware of the importance of self-marketing.
Yeah, correct.
That's the first thing. The second thing is the financialization of the young, right? Without apps like Robinhood, I mean, Robinhood basically financialized, I don't know how many % young people during COVID, right?
Yeah.
Of course, easy is like a game like that, right? We don't have those things in Malaysia. We don't have the culture of self-marketing. We don't have the culture of basically people building apps, which make equities understandable. So right now, I understand it, right? The vast majority of Bursa Malaysia investors, retail investors, are people my age, which is a big problem because over time, you're just going to withdraw from the market, right? The young guys are not buying equities. I mean, generally speaking, they don't. Why would they want to go and buy some furniture maker, some oil and gas pipe layer or whatever, right? I mean, these are, they don't get it, right? They're buying something else, you know? And that's the third problem in Malaysia.
Yeah.
We are listing companies, yes, from SME sector, but how technologically innovative are they really? If you want to talk about the business prospects over 5, 10, 15, 20 years, right? Where, right? I mean, you're going to, half of them are going to be disrupted by AI. Do you know what I mean, right? So then, if you're like talking from the point of view of the individual investor, right? And you're a young guy, 25, 30 years old, you're going to put your money, and then you want to try and beat inflation and try and retire in 30 years' time, right? Are they thinking about equities? I don't know.
I think at this juncture, the number of CDS account opening for the youth demographic has fallen from the COVID days. The peak was at the COVID days.
During COVID years, so many young people, they're just punting rubber glove, right?
Correct. So what I'm saying, I agree with you, but I think the main problem is our education system. Financial literacy is never part of the module. The closest thing you can say, for me, for example, during my time, was Kemahiran Hidup accounting module. And then I learned it at what age? By then, it's quite old. In Japan, financial literacy starts at 7 years old. So you see, that is where, US, I'm not sure how's the module like, but essentially, financial literacy have never been an important aspect of our education curriculum. So that is a problem from that level. Then of course, when you talk about gamification, apps and all this, of course that attracts them, you know, but even gamification is a problem. Like Robinhood, a lot were also speculation.
Yeah, of
so
course.
It's not only our problem. I mean, globally that's an issue. But having said that, I always think that investing should be in businesses, should be in management, and that is something that requires homework. And when it requires doing homework, youngsters generally don't like. And that's why you see a lot of them moving to what? Scams, forex schemes, or even crypto. Little bit to understand, high returns, high risk, understand it, and you may lose everything. But that is human nature, right? But what people like Warren Buffett has always been promoting is that you look over a long duration of time, you buy the right company, you'll be rich beyond your means. That was what he propagated. But how many really follow through? You know, very few, very, very few. But coming back to Malaysia is that Malaysia's problem, I think, is structural also. It's not just the youth, it's not just the education, it's also the structure of our whole industry. The capital markets, for example, fund management companies, when they invest, they all invest at the same time at a sector that is potentially hot, and they ignore the other sector during that particular year because they want to chase that yield. And if this fund don't go in, they also don't go in. If this fund goes in, then they go in. So you can see sudden surge in that particular industry or sector over the years. I remember you talked about furniture maker. I don't know if you can recall.
Yeah,
there was one
all these guys,
There was one time when our ringgit suddenly plunged from $4 plus from $3 plus all the way to $4 plus. They were all the superstars, right? Timber, lumber, anything that has exports on. Look at where are they today? Because it was an opportunistic short term. But if you really buy into good names, 10 years, 15 years ago, names like QL, names like Press Metal, you know.
The QL Press Metal days are gone. We want to find the next names.
Correct.
Who are they, right?
Yes.
Press Metal is a done story already. I mean, they're too big, really,
Matured.
right?
So those days are over. So you need to find the next. Where are you going to find them? only through the new IPO listings that come through the pipeline, or the companies that has been slowly growing, and on top of that, how many of the new generations or succession planning are coming into place, whether through institutionalizing or whatever it may be. There's still a lot of opportunity here, or who are going up the value chain, semi-con or whatever. So Malaysia has that compared to say Singapore. Singapore is worse because you see you got your REITs, your banks, your old economy stocks. They wish that they have such SME pool so that we can go and list there. But in fact, you see dual listing is happening here. People are there coming over to go for the premium. Coming back to Malaysia is that the capital markets also need to change. The landscape also need to change. So I've seen over the years, more aggressive capital allocation has been going towards VC, PE, private markets in Malaysia. Government participation in terms of allocating of capital has been done. But what I, of course, talking to you now, Chong, is, and you have the experience also, is that these capital allocations need to be more transparent. You need to give the capital allocations to people who are licensed, people who actually really know how to invest, rather than people who have the cable or relationship. The problem with Malaysia's VC-PE sector for the longest time, in my personal view, in Malaysia, instead of promoting startups, they are promoting companies which know the capital allocators. So it's again a relationship, click-based kind of thing, which is dangerous because the best founders or entrepreneurs may not be in Klang Valley. They may not even speak English. They may not even know a word of a language beyond what they are speaking. It can be Mandarin, it can be Tamil, it can be Malay. And these people always do not have access to capital. So what I'm saying is that when you go towards this kind of private markets capital allocation, it has to be more equitable. It cannot be based on who knows who.
I mean, this Dato Sri Liu, Lim, Eco Shop, right? He just reached like 4.5 billion market cap, right? He doesn't speak English. He come from somewhere in Johor,
Jamenta,
right?
that's right.
Jamenta, right? And he just built it by just hard work and his hands, bootstrap, 20 over years, right? And look at him now. And where got these guys? No private equity guys, This guy, I know this Tan Sri, no such thing, right?
Such thing.
The old-fashioned way.
Exactly. Even Speedmart 99.
Correct.
You know, those are very successful.
Mandarin speaker cannot speak
in
English.
Klang, you know, and some more handicapped. You know, that's why I always say that people say pursue the American dream. Actually, Malaysian dream is also very possible. We have seen people push through the envelopes of constraints. So I'm just hoping that if government were to participate in allocating more capitals to the private market space, it should be done in a more equitable manner.
The thing is, governments have never historically been good allocators of capital. You know that, right? They spend $1, they lose $4 I mean, generally speaking, because they have a national service, right? The private sector has to lead this, but the private sector are basically people who have gone through privilege, right? So they just allocate to people they know. Safer, right? I know you, Han, we went to LSE together, right, in London. Remember that time we went to the Spanish restaurant?
Which is dangerous.
Dangerous, because it's echo chamber.
Correct.
How do you know Dato Slim 20 years ago? You don't know, right?
I wouldn't know.
You didn't go to the same Kebangsaan school, right?
Correct.
Okay. So the other thing about people in Malaysia, right? I've been doing this podcast for years, right? I talk to investors, I talk about them about the principles and all that. You know, when you tell people how to do something and you have to learn the hard way, and you learn from the experts, people not interested, you know. People just want to be told, hey bro, you tell me what to buy and then buy. They're lazy.
I agree.
They're intellectually lazy, and that's how they lose the money. Then they say, oh, share market's the worst place, full of scams. Bro, no, bullshit, because you just didn't put in the work.
I agree.
Right? You bought this stock because your Hokkien Mee seller's auntie said it was a good tip. Bro, of course you're going to lose money, bro. Correct. That's the thing, people are lazy.
Yeah, I think this is the issue that we have always faced, not only Malaysia, but by right, after 1997, everyone is supposed to be more savvy, should be more careful.
I thought they were.
But no, what it did was it flushed them out. The so-called people who got burned were flushed out, they never returned to the market. That is the fact. A new generation came up, the same process go through. Actually, it's very simple. Back in the days, we had John So, right? Syndicate King, you know, pump and dump. Today, we have another group of people. And this group of people are manipulating a new group of people. And that is the problem, that as long as the capital market exists, there will always be this pool of people. So the first thing I always tell people when they investment, it's not about picking the right stock. It's about risk management. You filter out enough, you will realize you don't have many choice. And within that choices, you pick a few, you generally won't go wrong. But the problem is the temptation of not going towards that direction of that hot tip, that 10x within 1 month and all, you know, that is human nature. In general, that's how I look at it.
So how old are you now, Han?
I'm 36 this year.
Oh, 36, so young, right?
Yeah.
Okay,
That's why I had to leave.
Yeah, correct. But this is the right age, right? So the thing is, when you go and meet your friends, even maybe your younger friends, because you're still so young, right? When you meet someone who's 25 years old, and say, "Hey Han, you're so successful now, bro. Yeah, I got 10,000 ringgit now, right? How do I invest at 10,000 ringgit?"
Okay, very simple.
What would your advice be?
Okay, I will always ask them what is their risk appetite first, then their investment horizon. These two is the first two questions I'll ask. Because if they tell me...
Even at 25 years old?
Yeah, definitely. Because investment horizon would be longer, right? I would assume 25 years old, your investment horizon is 30 years old. But no, Chong. My investment horizon is 1 year. Because next year I need to go on holiday. I need this money.
That's the wrong priority already, bro.
You get what I'm saying?
Wrong priority.
So then I'll tell them that maybe equity markets may not be suited. Because I can tell you, this particular company is good, but you need at least few years to see their plans come into fruition. So this is the problem, youngster. Or I need to get a new iPhone. So you really have to ask them what...
Then you need to say, bro, why do you need an iPhone? You can buy a bloody Oppo lah, for God's sakes. That's financial literacy.
Correct.
Right?
Correct. And it's very hard to educate them through a process where I forgo the gain now for something. So this is something I'm trying to inculcate in my daughter now. She's 7. I keep telling her, you save the money here. Don't go to the bookstore every time to buy a rubber or eraser that you like. Save it so you have enough. But it's a process, you have to educate them. So if a friend comes to me, I'll tell them that first thing first, Malaysia has opportunity. It's not like what everyone say, Malaysia is full of scam. Because you see, if not, there won't be billionaires in our country. That's a fact, right? But if you say you want US or you want other markets, are you going to do the same amount or if not more homework? Because the market you're not familiar. The fact is that when you're sleeping, the market is operating. When you wake up, it's closed. Then you want to have to do a lot of studying or information, and certain things that is painted very well may turn out also to be a fraud. We have seen that Nicola, that turns out to be a fraud, right? They pulled the truck down the road, and it turns out this EV truck was a fraud.
What's the company called?
Heidelberg Research actually shorted them. So you see, even company that was invested by so many, if I'm not mistaken, General Motors invested in them, turns out to be a fraud. So if you want to talk about overseas, yes, I agree. Overseas investments may have greater alpha, but there's also pitfalls. Local, at least, whether Speedmart is real or not, you walk into Speedmart, you can sit there and see how many people go through, in, out, then you roughly can have a gauge. So start with something you're familiar, you're interested. So you say, Han, I'm not interested in convenience store. Let's go into tech sector. Okay, tech sector, what sector you like? Which particular industry? Oh, you're from Penang. Go to the plants and go and see. Go with your uni trip or student trip. At least you have that. So sometimes I realize that over a period of time, investors, if you choose something they are familiar with and you understand enough, chances of you beating the market is way, way higher than investing in something that you're not familiar with, but it's hot. For example, last year, a lot of people went to AI data data center team. If they went in at a peak, today they're all caught. They're probably down 25-30% year to date, right? Because it was the hottest team, it cannot go wrong. AI is real, use case is real, there's so many things. But then China come up with a DeepSeek, change the whole narrative and thesis all over again. We are now talking to data center suppliers, people who supply into the data centers, and they're coming to tell us that, orders has been slower. They admitted after 1-2 quarters. No, they're not pulling the investment yet, but slow. So we are seeing this kind of impact. And these kind of things happen is because people chase the fad or the hype of the day. People say, NVIDIA will forever be evergreen. I agree, but he needs to continue to innovate, right? If he stops or he's slower, AMD will catch up. China players will catch up. So it's a long process when it comes to investing.
Yeah, but the thing is, it's hard. Nobody knows the future, right? But would you say to a die-hard NVIDIA fan, they'll say, well, look, the demand is so strong for AI over the next 3 to 5 years. Yeah. They have a 3 to 5 year pipeline of incredible demand, right? So there's no reason why they can't go from whatever 3 trillion market cap to, 5 trillion market cap, right? Okay, that's 75%, that's not bad, that's 30% a year, but hey, okay what, right? So that's still good, right? So you can't say it's not evergreen because, so what I'm trying to say is that for the young investor who goes out and he tries to get some advice, it's overpowering, so much information, right?
Correct.
Is there like an ideal allocation strategy for them to say, okay, look, maybe you go and buy a property, and then maybe you go and buy some trusts, I don't know, or stocks or whatever, right? Do you talk to your daughter about these things?
I tell my friends, my peers who are wanting to eagerly start to invest, I always tell them that start off with excess money. Whatever commitments or whatever obligations, that should be a priority. If you don't have that, whether whatever debts or whatever, you don't have that, great. Then you're starting off free, no leverage. That capital, you start choosing particular names that you are familiar with.
In stock.
Yeah. Equities, no problem,
Yeah.
right? But must always have emergency fund set aside. 3 to 6 months emergency fund in case of anything happen. Then certain things like insurance you have to buy, those for rainy days. After all this is sorted, then you start looking at the market, right? Then whatever discretionary spend that you think can delay, that amount will then go into your investment pool. Then when you do well, of course you can take profit and reward yourself, But if you really believe in that particular stock or whatever endeavor, Nvidia or Berkshire or whatever that you like, just hold it. That particular can be your evergreen. Actually, my very, very first investment that really I didn't know where to start at all was coming across a Forbes magazine write-up on QL. It was that simple. And at that point in time, they were nowhere where they are today. I just like the story. I think this guy, these people, this family, their values, how, for example, my elder brother had no chance to study, took care of us, lent him my car so that I can go to university to complete my education. And now that I can come back, serve the family, even though he never worked, I will still give him a share in the company. This kind of values, I said, this company will go far. And I just allocated capital non-stop into the same amount. And I make my first investment success. Of course, I've lost money in other stocks as well. But this kind of things is because I can relate to it. Find something that you can relate to and start there. Start small. I started with 2,000 ringgit at that point. Then I keep on, every month I just pour into this particular stock. So there are stories like that. You just have to find. And it's hard, I agree. But there are very good management. There are very good people in our country.
Yeah. So let's just say, because investing is all about the future, right?
Correct.
So how are you, what is your thought process in terms of capital allocation for the fund? Say for the next 1 to 3 years, where do you think the returns will be?
Okay, I think it has to be a blended between private markets and public markets.
So nothing, okay.
It cannot be 100% public. It cannot be 100% private.
Okay.
Because private, we have seen, if you any VC funds, they all underperform in the past 3 years.
Yeah.
Easy credit, they all lost a lot of money because they all pay premium valuation for startups, and now many are stuck. Fund life has come to an end, they're asking for extension. So pure private also cannot, pure VC also cannot. So it has to be a blended strategy. Public markets will always go through up and down.
Okay.
If you can get 8 to 12% consistently from public markets every year, you are already hands down one of the top performers in the country.
Exactly.
Hands down.
Yeah.
Okay. Then private, that's what they will give you the extra alpha. That's where you go for 20% IRR over a span of 10 years. The first part you may not get it, but eventually you get there. So it has to be blended in that context. So public markets should always take a portion. Then fixed income, when I talk about fixed income, it's your bonds, your sovereign, your treasury, those kind of stuff, you will always have a component of it, right? So it really depends on your size of the pot. When we talk about bonds and fixed income to our clients, only if their pot is substantial. But if their pot is still very limited, equities allocation within it, you diversify, you still can do well. When I thought equities include private as well. So you diversify, that's how I'll look at it. So internally, our strategy is very simple. At least 50%, 60% will be in public markets. 20 to 30% will be in private. Then the balance will be on fixed income or whatever. Some people say they like gold, silver or whatever, that's your choice, right? But we do not, the only thing that we do not allocate is crypto. Okay. Our firm don't do crypto. That's the only thing that we don't allocate. Okay,
so on the private market side, right, and you've got the whole SME sector, thousands of them, right? What is your thinking process in terms of which sectors you like, which industries do you like?
I think I like sectors that is going through innovation, not stagnant. The only industry I don't touch, Chuang, is F&B.
I don't blame you.
That is the only one I don't touch. And we have a very strict policy of not touching F&B. When I talk about F&B, it's restaurant, cafes, bars, whatever.
Just because it's too unpredictable.
No barriers of entry, low. I mean, of course, there will be occasional outliers like Oriental Coffee that really did success, but majority of them. And because we don't trust the Malaysian food enthusiasts, because we all are so critical, our taste keep changing. Today, this nasi lemak may be the best, tomorrow is another nasi lemak. So that industry is too complicated. So to cut this out aside, we look at industries that are innovative. So if you talk about tech, fintech, or companies that are involved in some element of tech, that will be a priority. But it's not those kind that bleed till you make it kind of tech. It's really proven monetization model, recurring model, you will go for that. Then of course there is your value up industries. So industries like say we were looking at a company that was doing trading. Traditionally, they only done normal trading, right? Normal. But they're now going to a next extent of also going through distributorship. So they're improving from instead of just doing this one end, they're going up. And then from that process, their margins will expand. So we look at things like that. So there are a lot of opportunities in Malaysia, even medical healthcare. There are a lot of players that are doing very well and has become billion-dollar companies over time. But along that value chain, there's a lot of small players. So Malaysia is amazing when it comes to a number of SME business owners. The only problem is whether can you filter out those who are genuinely, honestly running the business for the business or just for their own pockets. So that is the dangerous part that investors really have to
Have you ever had your hands burned or not?
We are still okay because those that we are burned is at public markets, for example, we can exit easily. But private markets, thankfully, not yet. And because it hasn't come to a point where we have to exit yet.
I've seen all kinds. I mean, I remember there's one grow something, Labuan-based seafood. You know that one? Even the big wigs were investing. Huge scam, right? Then the other one I've seen is Yinsen. They went from 60M market cap. I think they were doing haulage for oil palm, right? Then they moved into FPSO, oil and gas, and then Sun did really well. Then from 60 million market cap to like 15 billion, market cap, right? That's incredible, incredible return. Your 10,000 ringgit will become don't know how much really.
So that's why there are a lot of examples that these companies started small. Actually, even our glove makers back in the days they were sub 100 million. They were sub 100 million. So another thing you all must look at, I always tell them, is that whether this particular business is purely domestic centric, or there's an export market, or there's a market beyond Malaysia. Because after all, our population is small. If this business is something that can be replicated in other countries or other regions, the chances of them growing to a next level is much, much higher. And most of the billionaires today that does well, to an extent, when I say to an extent, I'm not pinpointing anyone, but those purely domestic income driven, taking money or contracts from government or concessions usually don't last. But those who have a market outside of Malaysia and have proven to have consistent demand, most of the time they are at a billion-dollar level. So you have to find businesses that has that kind of export, or not to say export, but at least got an ability to replicate that business abroad, right? For example, I'm looking at one noodle company in Klang, 50-year-old. It's doing very well, halal certified. They are not only doing their own brand, they are also OEM for other countries. And
so many of them are there.
And there's so many of them. The problem with them is that they grew it bootstrap and bank loan. So they are now going through a transition. The question is that if anyone can find them to give them the sufficient growth capital to pursue more markets, open up more markets. Unfortunately, the baby boomers generation, the founder generation is, I'm so tired. I'm 70, 80 now. Want to do whatever, leave it to my children. Then the children's question is whether they have the fire to grow it. If they say, I'm also happy where I are, essentially that will be the ceiling. So then it comes back to management. So whether the management has the drive to push. If your management has no drive to push, even if you have an easily replicated model, there's no upside.
Stops there already.
Correct.
Okay, so move on to public markets, right? The growth in the next 1-3 years, right? I mean, you look at Asia only specifically, right? Hong Kong.
We are seeing that Hong Kong, China is bottoming. This year we have increased our allocation there. We are very lucky because when we started in 2022, that's when the China market has started coming down. A lot of peers actually lost money in Hong Kong, China, despite years of making money there, right? So we are at a point, that sweet spot where we think that the China-Hong Kong market has bottomed, despite all the noise of trade tariff and Trump and Xi Jinping's call happening or not happening. Essentially, we think China-Hong Kong is at a bottom, we would say at the bottom. The question is when it will really...
The problem is fund managers have had their hands burnt from this thesis the last 3 years.
Correct. Because everyone thought...
they're waiting but never came, right? What makes you think it's different this time?
Because two things. Because if you look at the attitude of presidency and the entire leadership or administration towards private sector businesses now, very different from 2-3 years ago. The most iconic picture would be him shaking hands with Jack Ma. That is a signal. It was an intentional signal to the world, right? Why him? Because that was when the problem started, right?
That's like reading the tea leaves, bro.
It is. That, unfortunately, that is the fact when it comes to China. That is their...
The messaging is very subtle.
Very subtle, and that's how they do. But if you read a lot, which we do, in the policy papers and the banks being given a lot of liquidity to support the market, you start to realize that even the attitude towards Hong Kong has changed. Before this, they say Shanghai or Shenzhen will replace Hong Kong as the financial hub of China and everything. Recently, they came out and said, no, Hong Kong will always have the predominant position as a financial. They even opened up the Connect. And if you look at the H shares, actually performing better than the A shares. Traditionally, it's the other way around. So there are a lot of signs to show that things are different this time. But I cannot say when. That's why you ask me 1 to 3 years. If you give me a 3 years horizon, Hong Kong, China is where I'll put my money.
Half these guys are still underwater by 50, 60%.
40, 50,
Yeah.
40, 50, correct. 40, 50%. Definitely, because at a point in time, let's just say Alibaba was 300, 200, 300. Now it's 100 plus, right? Tencent was at its peak, was 700, or most people say will go to 1,000. Now it's at 400 plus. Ping An was 90, 100, now it's 40 plus. So definitely, I believe a lot of them are still under if you buy at the peak, right? But I believe the bottom, it's there. Another part you have to look at is Southeast Asian market. Cannot ignore this market. Question is which stock exchange, which country. Thailand is going through one of the worst period that Malaysia probably been through the past few years, right? Changing government a few times, everything. This year alone, Thai market is down 21%.
Bro, but I go there, the economy is booming, bro. It's rocking, bro. It's crazy.
So foreign
The prices are 20% higher than KL.
So coming back to it is that if you look at Thailand, do you think it's the right time to bottom fish? Is it?
So
you went there, you see it, you think actually probably these are noises at the top level. Some of the very big names are actually 52-week low or even a 2 years low.
What would you buy in Thailand?
Thailand start off with the blue chip names. You won't go wrong in any foreign market. I always tell people if you want to go foreign market, start off with blue chip. Don't go and play small mid cap that space until you're very familiar, right? Opportunities, of course, will always be in the small mid cap, just like Malaysia, right? But if you do not know the ecosystem there, don't get yourself burned. That's how I look at it. Indonesia, big market, are going through leadership transition. You're seeing some corruption drive, but they're also setting up a sovereign fund. So there's certain ideas, certain things that are going together that seems to be working well. But they also have recent big fraud scandals like e-fishery, was supposed to be the best, most valuable aquaculture in the world, darling of Southeast Asia, and turns out to be a fraud. Things like this. So Southeast Asia is still developing, but it's a market that you cannot ignore. Very simple only, because other developed markets, their population is getting older, aging nation, labor force is shrinking. We still have a very young labor force. And wealth transfer, according to your productivity, that's a fact. If the country is productive, your economic returns, your growth engine is there. If your economy is not productive, 4-day work week, Saturday, Sunday, no career service, everyone is talking about equal rights. Then you
don't buy Europe, man.
Unfortunately, but there are a lot of capital have been allocating there because they don't want to put in US, China. They went to Europe, and Japan was quite pickish.
There's been no returns the last 16 years in Europe, nothing.
So there's all been allocating that side. But if you look at from the technological front, their EU regulation is choking their technological development also. Innovation. So productivity, innovations choked. I wouldn't look at that particular market. So that's why we're not keen on Europe. But of course, they will have always some very star companies like ASML. All these are from Europe. But those are very, very, very small exceptions, right? So a lot of people are also asking me about Japan. Japan did very well, simply because it came through a 30-year low. Upside is there, But do you think it can grow without, say, change in immigration policies, capital markets opening up, liberalizing, stable politics, So these are a few considerations when you look at other markets. So macro then plays a very important role. So for us, for example, whenever we make a decision, it's not as simple as, Han, you're using a top-down approach or you're using a bottoms-up approach. Whenever we discuss in the IC, we also have to consider our investment committee, IC. We also need to ask ourselves, what is our horizon? The fact is we cannot get everything right. So that's a fact.
Of course.
And I make so much more mistakes than what I get it right. But if I get it right, I really, really get it right. So our team essentially have to understand that whatever we're allocating comes down to risk management, right? We allocate based on certain parameters or views that we take of the world. It may turn around, but at least to an extent, it's this one will counter this measure. That's why originally we're 100% Malaysian focused. Today we are 75% because we see opportunities in other markets. But does it mean that I neglect Malaysia? No. I will still have sufficient exposure here. Then I slowly will look at where the opportunities are. Will I eventually go to Thailand? We've been looking and waiting for the past 16 months and they still cannot resolve their political issue. So, Indonesia is another market that we think is very exciting. Long story short, this part of the world has a lot of potential.
Yeah. I'm surprised you're still buying bonds though.
Our bonds is just a very small percentage. It's just to give us the
It seems as if the whole bond market, the whole entire system seems to be so much less...
specifically US, not so much Malaysia.
Yeah.
Because if you look at the foreign inflow for our bonds in Malaysia, even though our...
So these are government bonds or these are corporate bonds?
Government bonds.
MGS?
MGS.
Okay.
MGS. Corporate bonds, we are very careful.
Yeah,
very careful.
Of course.
We have been proposed many times, but we don't really look into corporate bonds. Because if you really want corporate bonds, you might as well take equity.
So you're just taking safe refuge in the 10 years of the
Yes, correct.
Yeah.
While waiting for opportunity. Because sometimes...
So that's the piggy bank lah, is it?
In a way, yes. Because you cannot take clients' money and do nothing.
Yeah.
When I say do nothing, meaning that you
Keep
say
cash
just
lah.
keep cash. Yeah. But cash you also need to have returns, you see. Yeah. So it's either a money
They can
market
keep
or
cash, you cannot keep cash.
Yeah, correct.
So you're 100% invested right now?
No. When we say you keep cash, it means that we put into money market. So we probably... Our boutique fund structure is a bit, again, different from unit trust. So this is where I explain. Unit trusts have to invest in all times. Good time, bad time, they have to invest. Right? That's also where they are a bit handicapped compared to us. We don't have to invest at all times. But we need to put it into an asset class. The question of asset class is can be money market, can be bonds or whatever, low risk. So we are always about 30+%. That's our level. Yeah.
Okay, so I want to talk to you about just some quick short snippets, right?
Yep.
Just now I asked you about how would you advise a 25-year-old with
correct.
10,000 ringgit to spend. First of all, I don't think most 25-years have 10,000. Let's just say they got at least maybe 1,000 at the most. Okay, so flip the equation, right? If you were talking to someone who's kind of roughly my age, 50, 55.
You're so old, man? No lah, you look so young and fit.
I buy you beer, I buy you beer. Okay, so roughly someone 50. And then they realize, oh shit, I'm going to retire in 10 years' time. I don't have enough retirement funds, right? What's your general advice?
Okay, I think the biggest danger is what I've noticed over the years is agents convincing people to take out from the EPF to put into unit trust. That is a no-no in my view, right? Even we have an internal policy, Chong. Anyone who comes to me and tell me they want to put EPF money, I will reject. I want the AUM badly, but it is our internal policy to never take people's EPF money. So the answer to your question is the first thing I'll do is max out your EPF. If you can, max it out, including the voluntary top-up.
100,000 lah.
Yeah. Because I'm sure at that point in time, people have savings and they don't know what to do, right? And not everyone will buy land or real estate. And to be fair, the real estate has been on a downtrend for the past decade. Recently only came up, right? So first thing is max out EPF. That's what I would advise. Then you got extra. If you're still working, you put into the tax deductible PRS, just that tax limit, you maximize all your tax benefits,
The PRS has been horrible.
4% plus lah. I mean, but you are going for the tax returns. You're not going for the absolutely. It's a tax break every year, right? The excess, that is where you have to think carefully, right? If you have substantial exposure into real estate, my advice is to avoid buying more real estate at that age. Because first,
you can't get loan anyway.
You can't get loan. Second thing is, even you can get loan, it's a very shorter tenure, which means your repayment is higher. So there's pretty much no point. That means that your real estate have to double within that short tenure period, so avoid real estate. So that means you're left with a few asset classes only. Either your fixed income, either your equities. So I would say go into equities, but go into dividend yielding equities. Example, your banks. 6%, 5%. If the market is good, you get an additional alpha of 15, 20%. So those are no-brainers. Some people say, consider some REITs, stable REITs, not REITs that are sketchy track record. When I say stable REITs, for example, if you think that IGB malls will continue to do well, take an IGB REIT or a Sun REIT or whatever it may be, REITs that has shown track records. Because why? You get every year 6-7%
every quarter in some cases.
Correct. And an industrial REIT called AME REIT also did very well. So those are the kind of things I'll look at. Maybe even utility names. Actually, a few years ago, there were plenty of opportunity to buy Tenaga. Plenty.
Well,
$8 now is 14 because of the whole team plus dividend. But people were saying that I remember one of the main theses a lot of fund managers at that time didn't want to buy Tenaga was government owes Tenaga a lot of money because they don't want to let them increase rate, then there are a lot of receivables they haven't paid back, that kind of stuff, right? But of course, all these are now water under the bridge, right? So look at some of the very yielding names, right? And then utilities or those. Don't go for telcos. Don't go for circular downtrend stocks.
Don't go for telcos.
Don't go for telcos. Don't go for circular downtrend. Because when you look at certain business model, you know that they are facing intense disruption from technology. Right? Telco makes money from your SMS messages, your text, your call and line, but now everything is free, right? Why do you still, then you pay for data, but data is a price war to the bottom. So those are the things I would avoid, right? Then coming back, if you're talking about selective stock picking at that age, is a bit difficult because you need to do a lot of homework. But when you're at a retiree age with enough nest egg, why do you want to bother? It's so fun. You should enjoy your life, right? You should go out there, go for holiday or whatever it may be. So this is how I would recommend a senior's portfolio. Boring but safe.
Okay. So how much money do you think people need to retire with?
This is EPF's recommendation or my view.
Your view, you're the money guy, or you should know what.
It all depends on the...
Okay, just say your average Joe, the normal Joe blogs in Malaysia. How much money do you need to retire on?
If you keep your money in the EPF, every year you withdraw, the amount that you withdraw, that means the dividend or whatever, if it eats into your capital, that amount should be at least half of your last drawn salary. Ideally, if you want to maintain the same quality of life.
If your salary is 10,000, you withdraw 5,000 a month, right?
Yeah.
You need to have, I think, 40 times, was it 20 times that amount, right?
Yeah, depending how many years you project that you will leave.
Okay, so that's, how much is that? That's 2 million, is it? Something like that, right?
About 1.5.
1.5 million.
1.5.
So 1.5 million, your EPF can give you a 5,000 ringgit annual, monthly salary.
Thereabouts, yeah.
Which is actually not a lot. So people,
So Malaysia's cost of living it will still increase over time, naturally, right? But that's where your returns from EPF will help to negate supposedly negate inflation. Now, if you have real estate, then you're very lucky because I believe that, let's just say you bought a house 20, 30 years ago, even at the lousiest location, if it's completed with a roof or working electricity, and at least it will double or triple. So then that asset class will also become an alternative for you to monetize if you see that the EPF retirement savings is insufficient.
Okay.
So that's another thing to consider because you have to become asset light. I'm talking about average Joe, right? So why baby boomers in general, I know in general, majority of their wealth is tied to the real estate. The only question is when to pull the trigger to sell because you don't want to sell too early, right? So it all depends on your health conditions and your other needs as well, right? And of course, whether your children depend on you or vice versa, So these are the few considerations you have to take into account.
Okay, one more question, huh?
Yeah.
Okay, before we finish, okay?
Can.
Why don't you look at digital assets?
Okay, number one is because my own lack of understanding of it. Okay, if you don't understand something you invest, it's like walking blind in the dark. It's essentially, that is the main reason.
Okay.
Second thing is that I haven't seen the actual use case or intrinsic value beyond something that people say, can make me rich overnight, right? So these are the two main reasons why I don't consider digital assets, right? Then of course, there's also issue that our fund and our client profile essentially is not suited or tailored for this asset class, right? Yes, some of them, okay, never mind, you put a bit, but I do not want to bear the responsibility of losing clients' money over an asset class that I'm not familiar with. So it's a very, very simple reason. It's not because I'm anti anything or I have an agenda or anything. But if let's just say someday the use case become clear, the intrinsic value is proven, and it's not because Trump says that it will go to how much, or Katie would say that it's worth how much, or how people say fiat is dead. It's not all this narrative that is being painted out there. Then maybe we can always open up our minds to consider this asset class. But until then, it's good to be prudent with other people's money.
Exactly. Okay, man, thanks a lot.
Thanks a lot, Cha. Really appreciate it.
Thanks.